All right. Good morning, everybody. Welcome to taxes. The lovely, fun world of taxes. So I know this is generally a pretty dry subject. First of all, good morning, Shantae, Leo. Good morning. Thanks everybody for being on. If you're on as well, drop a comment in. Let me know you're there. Got two screens going here, so I'm kind of checking comments and things of that nature as we go. So as you have questions as well, drop them in the comments. We'll get to any questions that you have. But again, morning, Jasmine. Uh, Good morning, Christy. Thanks for being on. I appreciate everybody being on today. So, taxes. We know taxes aren't the most fun subject in the world. It's generally kind of dry and boring. And the reason I like to cover this, though, is because for one simple reason that as your income grows, right, when we talk about wealth creation, step one is create income, step two is increase your income. All right, but as your income begins to increase, your tax liabilities increase with it. So over time, if you are not knowledgeable in the tax realm, taxes may become one of your largest expenses. So what I want to cover today is how do we legally reduce our tax liabilities. Now, I think I'm required to say I'm not a tax accountant. I'm not a tax professional. I'm just a guy that reads and studies and listens to people. And, I go to a lot of trainings and stuff with people that are tax professionals. So I take guidance and advice that they give, and then I take it to my accountant and see how I can use it in my business. So what I would say is that if you intend to implement any of the strategies that you're learning today, talk to your accountant first. Don't start doing them. Talk to your tax professional. Make sure it works for you. Now, when we look at taxes as a whole, and I often say this, there's thousands of pages of tax code, and there's several hundred that are on how to pay your taxes. And then there's thousands of pages that are on how to legally avoid from paying taxes. And if you think about it, our tax laws are structured in a way that the government is going to incentivize people in two ways. One, by creating jobs, or two, by providing affordable housing to people. So because we know that and we look at the tax strategies that are in place today, we can start to play the game that, let's say, the wealthy play. Think about it, create jobs and provide housing. Those are two of the incentives the IRS gives us to offset our income tax. So we're going to dive into some of that today and say, well, even maybe though I'm not a business creating jobs, how can I offset some of the income or all of the income that I'm making? So let's dive in. So the first thing I want you to think about is this: deduct it all. What if you could make every dollar you spend tax deductible? What I mean by that is every single dollar you're spending, what if it were deductible in the eyes of the IRS legally? And instead of asking, is it deductible, start asking, how do I make it deductible? How can I make this expense deductible? Is there a legal way that I can make it deductible? So I want you to start thinking about that as we move into this. Now, how we make our money is extremely important. So how we make our money, and if you've ever read any of Rich Dad or Robert Kiyosaki, he's got this. This comes from some of Robert Kiyosaki's teachings. He's written a lot of books. He's a real estate guy. Rich Dad, Poor Dad's probably the one he's most known for. Highly recommend reading that book just from a mindset perspective and how you think about money and wealth. Check it out, Rich Dad, Poor Dad, if you've never read it. But anyway, he talks about this as he calls a cash flow quadrant, and we essentially are earning income in one of four ways. Anyone that's in the marketplace, in the workforce, is earning income in one of these four ways. One is an employee. As an employee, you have a job. You show up for your job, you do the work you do the work you're supposed to, and you get compensated for it. That's an employee. Now, for S is self-employed. So self-employed, now we own a job. So a lot of people think I'm self-employed, I'm a business owner. Well, in a lot of regards, we own a job. And what I mean by that is if I stepped away from my self-employed business, how long would it run without me being involved? And if the answer is not very long, then I own a job, right? So be thinking about that as well. A lot of, there's a high statistic of small business owners that have one or none or no employees. Right? They own a job. They don't necessarily own a business. The other quadrant, as we move to the right now, is a business owner. So a business owner, we own a system and people work for you as a business owner. And as an investor, we're putting our money to work for us. Now, why do I bring this up? Because as it says at the top, how you make your money is important. Now, as an employee, I don't have a whole lot of deductions. As a W-2 employee, unfortunately, I don't have a lot of tax deductions. And so because of that, I could potentially be paying 40 to 50% of my income, depending on my tax bracket, between state and federal, right off the top. There's not a whole lot I can do to protect that money. Now, keep in mind, being an employee is not a bad thing. I've got people always say, oh, working for the man or working for somebody else, this or that. Keep in mind, most small businesses break even or lose money. So being an employee is not necessarily a bad thing if you're employed in the right place. I know somebody that's an employee of a large company, makes $3 million a year. I would be an employee making $3 million a year. That is okay, right? So the challenge with him making $3 million per year, and I don't know his tax structure by any means, but let's just say, and I don't think it's set up this way, but let's just say that was all income. If that was all W-2 income, he's giving away about half of that to the government, and there's not a whole lot he can do about it. So if he was affiliated like as a partner or something or receiving profit distributions, different story. But let's just say for conversation's sake, $3 million is W-2 income. 50% of that or more is going directly to the government in the form of taxes, and there's not a whole lot he can do about it because he's a W-2 employee. Now, as a self-employed person, we run the risk now as a self-employed person, and all of realtors in here are self-employed people. As self-employed, we run the risk of potentially having to pay more in income tax, over 50%, maybe 60%, because now we are also subject to self-employment tax as well. So if I register my W-9 as a sole proprietor, I am going to pay a lot in taxes. So we have to be looking at how do we structure things as well. So one thing you could be looking at and talking to your accountant is if you're not currently structured as a professional corporation, you may want to look at that. We as a real estate brokerage can pay you as a professional corporation. It's a PC. You might have heard it as a PC. So setting up a PC might be a route to go. I would talk to your accountant about that and see how it can offset potentially your self-employment tax. So that's one thing to look at. Also registering as an S Corp. Now, as an S Corp, as a brokerage, we have a challenge paying S Corps because the S Corp has to be set up solely to receive commissions, and that's it. But again, talk to your accountants about these different things. Just bring up PC, professional corporation, S Corp. Start talking about that because how you make your money is important. Are you incorporated or are you receiving money as a sole proprietor? If you are, you might be subject to paying more taxes. Now, as we move to the right category, as I mentioned earlier, as the IRS is incentivizing us in two ways in a lot of regards, and that's to provide housing or to provide affordable housing and or to provide jobs. So as a business owner, if I now have 200, 300, 400 employees and I'm creating jobs for people, well, then I'm subject to a business tax, which is around 20, 21%, which we know with a lot of what's going on in the economy right now, people are wanting to raise that. There's talks of raising it, lowering it, all of that. So, but as a business owner, I get a tax break there. And you could too if you employed a lot of people. Now, the one thing we can all do though is become an investor. So we can put our money to work for us and essentially get our taxes to 0% potentially. And that's what we're going to talk about today. We're going to focus a lot in the I category because this is something that everyone can do. Like some of you out there right now might be saying, well, I don't want to have a 100-person business or a 50-person business or a 500-person business. Sounds horrible. But what I could do is go buy some real estate and offset my income. I could start investing my money and defer my income. There are things I can be doing from an income perspective. So let's dive in. Now, business expense rules. One, in order to expense something or to deduct, we have to have what we call, has to be of a business purpose. Is what I'm spending my money on today have a business purpose? Me going to the grocery store and buying groceries is not a business purpose, therefore I cannot deduct that. So it has to have a business purpose. It must be ordinary, meaning it's an ordinary expense in my business. It must be necessary. So what does that mean? It must be necessary from the standpoint of, is it necessary to operate my business? And it must have documentation. Now, this is where people get hung up a lot. They don't document. Make sure you document all of your expenses. The better you get at documenting, the better off you're going to be at being able to offset taxes, because in the event an audit does come, they will be looking for documentation. Now, credit card statements, for what I've been told, don't necessarily count as documentation. I need receipts in addition to credit card statements. So if I'm looking at my monthly credit card statement and I'm putting it into QuickBooks and I'm logging all of that, but I'm not saving any receipts from any purchases I'm making, I could be in trouble in the event of an audit. So make sure you're saving and documenting receipts. Very, very important that you have a paper trail. So those are our rules around business expenses. Now, let's dive into some personal deductions. So personal deductions, we get the standard deduction, we know. And again, as a W-2 employee, there's not a ton I can do, but a lot of times W-2, you might have a 401k. And especially if you're getting an employee match, I would recommend taking advantage of that. With a 401k in 2024, you can basically put in $23,000 in that. And if you have an employee match too, why not? A simple IRA. Now, I'm only going to scratch the surface on some of these things, because as we get into our wealth series here in a couple of weeks, we're going to dive deep on why we should be investing our money in some of these. So I'm going to scratch the surface on this and talk about from a deduction standpoint. From a personal deduction, again, from a simple IRA, if I'm a business owner and let's say I self-employ, I'm a self-employed business owner and I have several employees, a simple IRA might make sense where I can then put $16,000 into my IRA and I can defer that money. So that's $16,000 I do not have to pay taxes on or income taxes on now. I'm deferring it to a point in the future, maybe when I'm 65 or when I'm at retirement age. So simple IRA is $16,000. Now a Roth IRA, I have this in here. There's really no deduction to it, but I just wanted to touch on it. The Roth IRA is, in my opinion, one of the best financial vehicles out there to take advantage of. And so with a Roth IRA, and I'm looking at my income limit here, I could put away this year $7,000 into my Roth IRA, or if I'm over 50 years old, I could put $8,000 away. And that's if I'm making less than $161,000 per year. So what I'm looking at here is I could put this money into my Roth IRA, and this is after tax money, meaning I'm not going to get any kind of tax break or any kind of tax deferment. But what I am going to get is this money will grow and compound tax-free. So if I put $7,000 a year away into that, from now until the time I'm 65, whatever money I start dispersing is tax-free. It's growing tax-free. So I'm essentially paying the tax on it today, and it's going to compound and grow tax-free. A traditional IRA is just in reverse. It's where I'm deferring my tax. If I put $7,000 into my traditional IRA today, then I'm going to be pay or defer taxes on that. So if I made $100,000, I put $7,000 in my traditional IRA. I'm not paying taxes on that $77,000. I then have $93,000 of taxable income. Now, here's one too. If you are a high income earner, the SEP IRA, it's a simplified employee pension. Big believer in this one. I like this one. If you're a high income earner and let's say you're over the $161,000 max contribution, so you can't contribute into your Roth IRA any longer, you can do what's called a backdoor IRA. We'll get into that one later. But the SEP IRA, I could put away $69,000 into my SEP IRA every year. Right now, the max contribution is $69,000 and not pay income tax on that money. So again, let's just say I made $200,000. I put $69,000 into my SEP IRA. I'm not paying taxes on that $69,000 today. I'm deferring it. So it's a tax deferment strategy where I will pay taxes at some point in the future. And the premise behind this is this money will grow and compound without having income tax taken out of it today. But in time, when I start to do distributions down the road in retirement, then I will be subject to income tax. So there's a couple of schools of thought there. One is that, well, what happens if income taxes go through the roof in the next 10, 20, 30 years, and I get to retirement now, income taxes 70, 80%, which could happen. But in theory, what we're thinking is that when we start dispersing and taking money out of our retirement in 10, 20, 30 years, whatever the case may be, our tax bracket will be at a lower rate as well, because we won't be earning the income potentially we're earning today. So I feel that at this stage of my life, I'm going to earn the maximum amount of income I can. Therefore, I'm subject to higher income. So if I can defer some of that income and put it off until the future, and then take tax deductions on it, or start paying taxes on that money in the future, I'm going to let it compound and grow tax-free right now. So I'm deferring. So those are some things to think about. If you've never heard of any of these, I highly recommend you Google some of them. The SEP IRA, if you're a high income earner, SEP IRA, Simplified Employee Pension, is something to look at. If you're a solo business owner, the SEP IRA might be a really good thing to look at. Now, those are just some of our standard kind of easy deductions. And what I say with that too is that's really kind of passive income, in my opinion. I take money, I move it. So I do a lot with my SEP IRA. And I used to have a Roth IRA in that, but it's a simple fact of I take money, I move it, and let money grows and compounds for me. We're going to dive deeper into that, as I said, in a couple of weeks. But again, I just want to start getting you thinking about some of these tax things here, strategies. Now, let's look at the Augusta rule. The Augusta rule is a really cool thing. So the Augusta rule is this. It says it's section 280, but it's titled, or the nickname is the Augusta rule. It allows homeowners to rent out their home for up to 14 days per year without needing to report that rental income on their individual tax return. So I'm going to read a couple of things here. The Augusta rule, known as IRS's Section 280A, it allows homeowners to rent out their home for up to 14 days per year without needing to report the rental income on their individual tax return. Originally, this was created to protect the residents of Augusta, Georgia, who would rent out their homes to the attendees of annual Masters golf tournament. The Augusta rule applies to any taxpayer who owns a home in the United States, provided that your home is not your primary place of business. So what does that mean? As long as it's not my primary place of business, I can utilize this. So how does this work for the homeowner? So I can rent it out for 14 days, and I can charge a reasonable and inline rental market rate for my home. So what do I mean by that? I'll give you an example. I have a friends that stayed with me. They're past clients of mine. They live out of the country now. A good friend of mine from college. They live in Europe. They stay with me for 4 or 5 days, and they used 3 of my rooms in my house. So I will then bill myself. My personal self will bill my company, and my company will then pay. I'm going to basically charge myself for those 3 room rentals each night. Now, it has to be in line with what a hotel is for the night. So let's say in my area, a hotel room for a night is $300. Well, that's $300 per night. That's 3 nights or 3 rooms per night. That's $900. Let's just call it $1,000 a night for 5 nights. That's $5,000. I can then offset and report and pay myself and not pay income tax on. So we're basically renting our house out. And again, the way this came up was, think about it, as I mentioned before, tax laws, hundreds of pages on how to pay taxes, thousands of pages on how not to pay taxes. And what essentially happened was the homeowners at Augusta National, now think about homes in Augusta National, they're expensive, millions of dollars, millions and millions of dollar homes, expensive homes. So they were receiving this rental income. People would rent their homes out. Golfers would rent their homes out. They were receiving these rental income, and it was a big chunk of money. And they're saying, well, we don't want to pay taxes on this. So this group of wealthy individuals got together, and they talked to their friends in government and lawmakers and politicians and got a law enacted that they no longer had to pay income tax on that money they were receiving when they rented their homes out for that week or however long that was. So now it says we can utilize the same tax loophole or the same tax law, not even a loophole, same tax law that is available to other people. So when you think about this, I can use it to rent my home. Now, let's just say you don't have any clients staying with you, right? Well, when you structure yourself as a company, you can now host board meetings. So you can have a board of advisors, maybe your wife or husband is your board of advisors, and you can host board meetings at your home as well. And you can look and say, if I had to go rent a public space to host a board meeting, how much would that cost to go rent out a venue or a space? And then I can then bill myself and invoice myself that for that amount and not be subject to any income tax. So those people who also claim they have an office and home, but this still apply, check with your account. That's a really good question, because if it's including your now for most people, no, because it's not going to be your primary place of business. You're going to have a home office in your home, but it won't be considered your primary. And because we also have an office space, most likely you can utilize, this is your office, and then you have a home office, which we will talk about the home office deduction. So it should not technically be considered your primary place of business because you do have a physical office that you can come to as well. But check with your accountant on that. Again, I'm not an accountant, so you need to run this stuff by your accountant. So yeah, really good question. but your board of directors meetings, right? So here's the thing, you have to document this stuff. But let's just say let's say I had a board of directors meeting 12 times per year, once a month, and it cost me $1,000. I was billing myself $1,000. I could essentially offset $12,000 in income tax that my business would pay me personally, and it's not subject to any income tax. So as you can see, again, some of this stuff isn't like massive amounts of money, but it could be. Right, so be thinking about that as we keep moving through this. My goal today is to start planting some seeds about some different strategies that are available to get you to take to your accountant, start talking through it, and thinking about that. So again, making sure that you document this is going to be critical. So this is a really, really good way, though, that you can offset income tax by utilizing the Augusta rule, Section 280A. Now, let's talk about owning real estate. So owning real estate and cost segregation. This is one as well. Let me move over my slides here. Okay, so this is a big one. So with a cost segregation study, now remember when I had the 4 quadrants, I had ESBI, investor. This is falling in line with that investor one. And so when we look at real estate, now what I would say too is your accountant matters. So there are some things I would be talking to your accountant about as well. One, if your accountant ever is fearful of an audit, I would look for a new accountant, because you don't want an accountant that's fearful of being audited. As long as you're utilizing all of the legal strategies and doing things correctly and making sure you're documenting, you should never fear an audit. Now, you should fear an audit if you're lying about stuff and making stuff up and have zero documentation. But as long as you're doing things legally, you should never fear an audit. Sure, it's an inconvenience, but you shouldn't fear it. So real estate cost segregation. This is one of the biggest ways to get a massive tax reduction that you can utilize. Now, when you have an accountant, a lot of accountants will say depreciation on real estate, you depreciate real estate over 27.5 years for residential and 39 years for commercial. So that's your standard depreciation, your straight line depreciation. And so 20% of which is land, and it doesn't appreciate, and 80% is building content. So keep that in mind. Land does not depreciate. In the eyes of the government, land does not depreciate. Land value, the physical land itself always goes up in value. The buildings could depreciate. So 80% is building. So a cost segregation study is going to dissect the various components of this property and determine how much you can compartmentalize assets and improvements into different classes of depreciation. So what does that mean? It means that with a cost segregation study, now there is cost associated with this. You're basically paying an accountant and an engineer to come in and say, okay, this property is not going to last. The roof on this property will not last 27.5 years. The furnace will not last 27.5 years. The flooring, the cabinets, so on and so forth. They're going to compartmentalize the improvements to this property and fully depreciate them in the first year. So what we're doing is, let's look at an example here. Now, let's just say, sorry, my cell phone keeps blowing up here. Let's just say I purchased a multifamily property last year. Just say the year is irrelevant, but I bought it for $700,000, and we're going to say the land value is $100,000, which, keep in mind, does not depreciate, and the building value is $600,000. So over my annual depreciation of 27.5 years, I get to depreciate $21,818.18 per year. And let's just say that property generates me $30,000 a year in income. So I get $30,000 a year in income. I'm going to take out my depreciation of $21,818, and that leaves me with $8,181 in taxable income, which not bad, right? So that sounds decent. So I'm depreciating my property, and I'm offsetting the income that I'm generating. So that is our straight standard depreciation. Now, something I want to look at is, what if I did a cost segregation study? So if I purchase that same property, and again, I have my land value of $100,000, doesn't depreciate on my $700K property, but I am going to take land improvements. So land improvements are things that I'm doing to improve the land, right? So like, let's just say, for an easy conversation, if it was a commercial building, I'm fixing up the parking lot. That would be a land improvement. Things I'm doing with land improvements over 15 years now. So instead of 27.5 years, we are now able to depreciate that over 15.5 years. So let's say I have 100 grand in land improvements. And again, in your cost segregation study, your people doing this, there are companies out there that do this. They're going to be breaking this down for you. But let's just say, for example's sake, I have 100,000 in land improvements. So I'm going to then get that to depreciate over 15 years, which is giving me $6,667 in year one, or per year. Now, equipment. Now, again, keep in mind, equipment could be things like HVAC, roof, things of that nature. I get to depreciate that over 5 years. So in my cost segregation study, out of my $700,000 property, let's, for example, say they said $75,000 in equipment, which is depreciable over 5 years. I get a $15,000 deduction in that first year. And with my building itself, I still get to depreciate that over 27.5 years. So that gives me 15,000. So it's the remaining depreciation. I take 175 grand off of 600, and that gives me $15,455 in depreciation. Now, here's the cool thing. Instead of depreciating over the 15 years and the 5 years, you can take advantage of what's called bonus depreciation. When you do a cost segregation study, you get to do what's called bonus depreciation. And what that means is that you can now take 100% of the land improvements and the equipment depreciation for year one and depreciate it fully in that year. So now what I could do is I get to take my $75,000 in equipment, and rather than taking it out over 5 years, I can depreciate it fully in year one. With my land improvements of $100,000, I can depreciate that fully in year one. And now what I'm getting is I can do a $175,000 deduction on my property. And then I take my other deductions in here as well. That's going to give me now, if you think about it, $212,000 in depreciation. So let's just run through this math again real quick. Okay, so 700K property, right? I pay for it. $100,000 is attributed to land, which is not depreciable. Left with $600,000. So instead of classifying all of that as building, for tax purposes, my cost segregation study says I have $100,000 for the land improvements, $75,000 is depreciation, and then in addition, accelerated depreciation you're taking advantage of. That's accelerated because it's not 27.5 years. I'm taking advantage of bonus depreciation, which is 100% depreciation for land improvements and equipment in the first year. So let's look at this. So in my numbers here, by taking advantage of this, I would take it from 21,000 to 212. So think about that. I'm taking these numbers now, and I'm able to fully depreciate all of my properties. So if I go buy one property per year, and let's just say it's not even 700,000, but it's a smaller number, and I was able to get a $25,000 or $30,000 or $50,000 depreciation, would it be worth it? So when you think about it, that's why you see people that buy real estate. They're buying real estate, and the key to this, though, is when you buy real estate, you want to make sure, let me go back to this, you want to make sure that you never sell it. So if you're planning to flip a property, you don't want to do a cost segregation study. If you're planning on buying this to hold, these are properties you're buying and holding, and think about it from a wealth perspective. How do I generate wealth? I buy things that go up in value and never sell them. That's kind of one of the secrets to getting wealthy, is buy things that go up in value and never sell them. If I'm buying things that go up in value and constantly selling them, I'm subject to more income tax and capital gains tax and whatever the case may be. But if I buy and hold, and that's what I'm doing with cost segregation studies, I'm buying and holding. Now, let's say, for instance, I have bought a property in 2018, and we know that home values in Missouri alone have gone up almost 60% since, say, 2019. I bought the property. Home values have gone up 60%. So let's just say I bought a property for, easy math, $100,000, and now it's worth $160 because I had 60% appreciation. Instead of selling that property and taking my $60,000 gain and then potentially having to do a 1031 to offset taxes or defer or whatever the case may be, what if I did a cost segregation study, fully depreciated the property, and then instead of selling it and taking out my property, I borrowed against my property. I went and borrowed against the value of that property, and banks are going to give you a certain percentage of the value in the home. I borrowed that and took a loan, and let's say I was able to get $40,000 from that property, and I got that in the form of a loan that my tenant is paying off because I have a tenant in place. Well, one, I didn't pay any income tax on that money because it's a loan. It's not income. So think about that too from us, and we'll dive deeper into this here in a couple of weeks. But that's why when you buy real estate, don't sell it. Buy it and hang on to it. You can always borrow against it. Tenants are paying off. Now, I know that Dave Ramsey and people like that think debt's bad and blah blah blah, and I think credit card debt's terrible. But I think leverage debt structured in a correct way can be a very powerful thing to help you build wealth. If I have $2 million sitting in real estate, rather than selling it to get $2 million out, what if I go borrow $1.5 million against it, or whatever? I'm not paying any income tax on it. My asset is still there. It's still generating me income. My tenants are paying off my loan, and I just got a surge of cash at a pretty moderate interest rate that somebody else is paying for. My tenants are paying the debt off for me. So the debt service is being paid by my tenants, and I'm generating income tax-free. That's how you can generate tax-free wealth, by owning real estate. So again, something to keep in mind here as we keep moving through this. Now, hopefully that was, we'll dive deeper into the cost segregation and kind of go deeper on some studies and even companies that do this when we move into the wealth series. Let's look at employing our children. This is a big one too. So employing our children, were you aware you could employ your children in your business? So again, how we generate and make our money matters. Because what I mean by that is, are we structured in a way that we could have our children work in our business? As a sole proprietor, the answer is no. If we structure ourselves as a professional corporation or looking at S Corp, things of that nature, now the IRS is seeing us as a business, we can employ our children. So we can have our children work in our business and pay them $14,600 a year tax-free. So let me read a couple of things here. Hiring children is a great tax strategy. If you hire your children as employees to do legitimate work, keep that in mind, very important, legitimate work in your business, you may deduct their salaries from your business income as a business expense. So moreover, if your child is under 18, you won't have to withhold or pay any FICA, Social Security, Medicare tax, so on and so forth. So on that salary. So let's think about a couple of things here. One, your child, the standard deduction for an individual is $14,600. So it's a pretty big number. So I could pay my child up to that amount and they don't have to pay income tax. Now, keep in mind that I have a caution note here too. So follow the rules. So the IRS is well aware of the tax benefit of hiring a child. So it's on the lookout for taxpayers who claim the benefit without really having their children work in their business. The IRS concludes that children aren't really employees. You'll lose your deductions for their salary and benefits. So one, they have to be real employees. So age matters. So I've heard a lot of people say 7 years old. So 7 years old is kind of the age at which their children can start legally working in their business. Now, again, this stuff has to be documented. So I've got like a friend who runs a kind of a mastermind. He has his daughters come to every mastermind. They pass out information to the mastermind. They speak at it, so it's a good opportunity for them actually to do public speaking because they're speaking in front of about 100 people. And he compensates them for their time there as employees. Now, they're doing other things in his business as well, but he's taking photos of that information, that stuff is being documented. That's one of the things that he is paying his children for. So that's something you could be thinking about. How do we pay our children? Could they help you with office work in your office? Could they help you with marketing stuff? Could they go hand out door flyers, door knock and pass out flyers and things like that? There are things they could be doing in their business. Now, what I would also say is, from an age perspective, again, this is where you have to have, depending on your risk tolerance, but a baby in social media advertisements and print advertisements, like for me, I'm going to have my baby in social media stuff and pay her as an employee. I would have to have some form of a baby around my marketing plan to have her in that. I'd have to pay a baby to be in my marketing if my marketing is going to be based around that. So why not pay my own child from the day she's born? So be thinking about that as well. How can we, again, the question is, how can we make this tax deductible? If I have a marketing plan based around my child, I'm not saying I'm going to do this, but maybe, could I make that tax deductible? The answer is most likely yes. So again, documentation is the key. I can't just say, oh, well, I had my baby in a bunch of social media campaigns that were never posted and never ran. But if they're actually on physical mailers that go out, things that go out to my SOI, social media post on social media, and it's not just like one a year, it's a campaign and strategy in place that's well documented. Well, then what I could do then is pay my child $14,600 per year, not have that money any subject Um, can I pay my child in non-cash benefits such as room and board? Well, you don't want to pay well, no, you can't pay your child for living there, basically, like living in your house. But what you can do is they have to be working in your business. So what are they doing in your business that then you can compensate them? And here's what you're doing with their compensation now. Let's just say I paid my child $14,000, say $1,000 a month. Let's just say $12,000. I'm paying them $12,000 a month. That money is going into their own account that I'm a custodian of, right? Because I'm on the account because they're a minor. So that money is going into their account, to their checking account. And then what I'm able to do with that money is I could set up things. And I saw Angie posted as the Roth IRA is a great way to a beginner investment. Absolutely, great way to start off investing. It is. And what I could do with my child then is if I'm paying my child $1,000 a month to operate in my business, one, I'm documenting that information and the work they're doing. And two, I'm taking that money, it's going into their account, and then maybe I invest 7,000 of that into the Roth IRA. In order to have a custodial Roth IRA, they have to have income. So now they have income, and I'm taking 7,000 of that money and putting it into their IRA. And then I'm taking the remaining money, which is what, 5,600, or if I'm paying them 12,000, it's $5,000. And then what if I use that money to pay for things like their sports? Like they're paying for soccer or gymnastics or piano or dance or whatever the case may be. Like I have nieces and nephews that are real involved in soccer. They travel all the time. What if I then use some of that money to offset the cost for those expenses? Now I'm utilizing tax-free money to pay for things that I was going to pay for anyway, but now it's not subject to income tax. So think about some things like that. So again, $14,600 per year to your child, tax-free. But again, what's important here is that we're documenting, we're making sure things are documented. They have to be a bona fide employee. And it says, I have in my notes here, the IRS won't believe an extremely young child is a legitimate employee. How young is too young? The IRS has accepted that a 7-year-old child may be an employee, but probably won't believe younger than 7 are performing any useful work in your business. Now, again, a lot of this stuff is written prior to like social media being such a big presence in our business. Right? Print mail, direct mail, advertisements, marketing, things like that. If you're using your child in those things, something to keep in mind. So these are ways, again, taking these things to your accountant and talking to your accountant about that. But again, it's ways to offset income. Now, in order to pay your child $14,600 per year, you may need to increase your income. Right? So for some, there might not be enough income left over to even utilize this strategy. So that's step one in the wealth creation is we need to go generate enough income to where we can start utilizing some of these things so they make sense. So again, if you have questions on this, drop them in. But that's another way you can be looking at it. Now, home office deduction. We should all be taking the home office deduction. So the home office deduction used to be a thing that was a red flag to the IRS back in the day. Today, it no longer is. Most people, especially after COVID, work from home or have some form of home office. So there's an easy way to determine your home office deduction. One, you have to have a dedicated space. Again, remember, as I mentioned, documentation is extremely important. You can't just say I have a home office and not really have one. You have to have a dedicated space in your home that is a home office that you're working from. So like sitting on your couch, that's not a dedicated space. A dedicated space is an actual office dedicated. Even if it's a section of a room, you have to have a physical dedicated space for your home office. Now, the simple way, you can do this where you offset and deduct all of the mortgage, the regular method, which is more difficult. So there's two ways you can determine, basically the easy or the hard. The easy is the simplified option, where you're not deducting any actual expenses. You're actually instead taking the square footage of your space, you're multiplying it by a prescribed rate. The rate's $5 per square foot, and you can have up to 300 square feet of space. So for myself, I've got a home office at home. It's about 300 square feet. So I get a $1,500 deduction per year on my taxes. So again, not a ton of money, but it's big enough. And I'll give you an example. I had an accountant years ago, and we were going through, and I owed a ton of money, and I was shocked. I was like, why do I owe this much? And so I started asking him. I said, well, I don't see my home office deduction on here. Oh, he didn't want to redo my tax filing. He's like, oh, well, that'll only save you like $500. And then there was something else, and I threw that out there, and he was like, well, that'll only save you like $300. And I said, well, wait a minute. In 2 minutes, I just have $800 less I would have to give to the government in 60 seconds of talking with you. And you don't want to go sit down and go through this because you don't feel like redoing it. So I had $800 in savings right there. That's $800 of my money that I was going to have to give to the government that I didn't necessarily need to because some simple things were overlooked and weren't added into my tax return. So when we start looking at stuff and saying, oh, it's only $1,500, well, it's $1,500 more in your pocket that you don't have to give the government legally because you have a home office. So be thinking about that and get away from saying, if you're a person that always says, well, it's only $50, it's only $100. Stop saying that. Look at it and say, okay, that's $50 or $100 more I can have in my pocket. That's how I can start to get ahead and get more money. Is like if I start to really hold my money accountable, I can then start to generate more of it, save more of it. So with the regular method, though, of your home office, you're measuring the actual expenditures of your home over your overall residence expenses. You can deduct mortgage, insurance, interest, blah, blah, blah. Just go the simplified route, in my opinion. It's $5 per square foot by the amount of square footage. So if you have a 300 square foot office, you get a $1,500 deduction per year. So again, home office deduction, if you have an accountant that says, oh, we shouldn't use the home office deduction, I caution you to go interview other accountants as well, because this is a very simple deduction now, and everybody on this call is working from home. All right, so I know that for a fact. Everybody on this call works from home. So chances are you have a home office. Make sure you're utilizing that deduction. Now, travel deduction. I get questions on this one a lot. So travel deduction, if I travel somewhere, it must have a business purpose, and I must work 4 hours per day in order for that to be a deduction. So what does that mean? Does that mean I can go to Bora Bora, and if I get on the MLS for 4 hours a day and search for homes for my clients, I can then make that trip deductible? The answer is no. It is not business I can bring with me. Business I bring with me is not a tax deductible event. So if I'm just traveling to Europe and I'm saying, well, I'm working when I'm there, I'm talking to my clients back in the United States, I'm sending them homes, I'm doing things, I'm working, it's not a taxable event. So it cannot be work that you bring with you. This has got to be stuff that why I'm going to this location for a business purpose. So again, I utilize a mastermind group I do. I go to a mastermind group, that's a continuing education event. That is a business deduction because I sit in a room for 8 hours per day for 2 days. And so I'm deducting that expense. I'm deducting my travel from that. I'm deducting my hotel. I'm deducting the cost of that event. We'll get into continuing education here in a moment. But if I go speak somewhere at an event, I'm being compensated to go speak at an event, that is a business deduction. If I go now, let's say I go to Colorado and I like to go skiing, and I intend to purchase a home in the mountains in Vail. Well, if I go look at real estate and I'm spending time to go meet with a realtor there, go to their office, go explore and look at properties, and I intend to buy real estate in Vail, even though I don't buy it, that could be considered a taxable event. I had a business purpose there, and did I work in that business for over 4 hours? Did I spend over 4 hours per day in my time there looking for real estate, even though I might not have bought? Now, if I did that every time I went on vacation and I never bought anything, that might be a red flag. But if that's my goal and intend to buy something and I'm traveling somewhere for that purpose, well, then maybe that's a taxable event. Maybe I'm looking to buy an Airbnb or a rental property in a certain area, and I'm going there for the purpose of that. I may be able to make that a tax travel deduction. So keep that in mind. It's not stuff you can take with you. I can't just go there and say, well, I'm bringing my work with me, so I'm going to work 4 hours. So it's going to be a taxable event. It's not. It has to be a business purpose, a reason for you going there. Now, vehicle deduction. This is a good one for the end of the year. While I don't advise you just buying a car for tax purposes, if you intend to buy a new car, then this is something you may want to look at. So I wouldn't say just buying a car for the sake of buying a car just so you get a tax deduction is a great investment, unless you just have a ton of money and it doesn't matter. But what I would say is if you're thinking about buying a new car, let's look at the 6,000 pound vehicle. So the 6,000 pound vehicle, for one, as a realtor, we get the standard mileage rate for business travel is 67 cents per mile. So that's gone up since last year. Now, 67 cents per mile. And so typically on that, I can take the mileage deduction, or I can take the expense cost, like my fuel and oil changes and things like that. Generally, because we all drive a lot as realtors, and the bulk of our travel is business because we're out showing property a lot, showing people homes, I tend to take the mileage deduction. the 67 cents per mile. Now, people will say lease first own. If I lease a car, I can generally offset all of the expenses of that lease purchase. But if I own, the 6,000 pound deduction, now this used to be a much better deduction than it is today. It used to be 100% deduction, and today it's 60%. It was 80, now it was 100, then 80, now 60. It's going away, but you can still use it. So what I'm looking at here is with a 6,000 pound vehicle, like an SUV, any vehicle over 6,000 pound gross rate. I'm going to read through exactly what this is, and it's called Section 179. So here's what I can do with this. So I bought a car 2 years ago. I was able to utilize this. The key, though, is you don't want to sell this car. You want to until its usable life is over. So here's the rough calculation. So let's say I bought a full-size SUV for $75,000, and it's used exclusively for my business. It's a heavy SUV over 6,000 pounds, and 100% of its use is for company business. I can take this deduction I can take the standard deduction through the Section 179 of $30,500. So that's how much I get to deduct off the $75,000 purchase. I can deduct $30,500 of that on my tax return this year. And then additionally, I can deduct the remaining cost of the $44,500. So that's $75,000 minus the $30,500 deduction. And so what I can do then is that's 60% of the figure. So basically, what's 60% of the $44,500? I know it's a lot of numbers. So what's 60% of the $44,500? That's $26,700. So my total write-off for the SUV is $52,700 in this year if I were to buy it for my taxes. That's the standard $30,000 500 deduction that you'll get, plus the $26,700, which is 60% of the remaining balance from your standard deduction to the $75,000 purchase price. So keep that in mind. If I bought a 6,000 pound vehicle this year, by the end of the year, before the year is over, and it was 75 grand, I could essentially get a write-off for that of $52,700. That's only if it's over 6,000 pounds. So again, if you're thinking about a car, and I wouldn't say just go buy a Range Rover for the sake of buying a Range Rover. Range Rovers do qualify, but don't go spend money if you don't need to, right? But if you're thinking about, hey, I've been thinking about getting a new car, it's been on my mind for a while, my car is becoming unreliable, whatever the case may be, instead of buying a standard car that's not 6,000 pounds, maybe look at this and take advantage of that because it will offset some taxes. Now, something else to keep in mind, when you have a home office, and even if you come to an office, but you also have a home office, when I utilize my home office, all of my mileage now, for the most part, becomes deductible because I'm leaving my home office to drive to my office here, and then I'm going out and showing clients, and then I'm finishing my day at my home office. I can now deduct all of those miles. So that's how I can start to deduct nearly 100% of the mileage I drive because I do have a home office in place. So something to keep in mind as well from a deduction standpoint, having a home office makes a lot of sense. So meals and deductions. So let's look at meals and deductions. I can deduct meals with clients. Absolutely. Can I deduct meals with my spouse? Well, the answer is yes, I can. Because chances are when I'm taking my spouse out, even though she might not be involved in my business, I'm still talking about my business to my spouse. Therefore, that can be a taxable event. So I can look at deducting meals with my spouse as well. I got a little note here. So you're a business owner or professional investor, and when you go to dinner with your spouse, do you ever talk about business? How many of us talk about business when we're at dinner with our spouse? Chances are it comes up. I would say 100% of us talk about business at some point when we're at dinner. So is there a business purpose to that meal? Yes, there is. You're talking about business. Even if your spouse is not involved in your business and knows nothing about your business, you are still talking about business. So that meal can become tax deductible. So be thinking about that as well. If I go out to a nice dinner, can I deduct that meal with my wife? Yeah, I probably can if I'm talking about business there. So meals can become deductible as well. Meals with clients can become deductible as well. Again, documentation is important. Make sure you're saving receipts. Make sure you're documenting who you went to that meal with, who you're having lunch and dinner with, whatever the case may be. And then education deduction. When you structure yourself as a PC and you're structuring yourself as you're incorporating now as a business, you can get more deductions on education. Make sure you're always labeling this though as continuing education. The IRS wants to see continuing education. I'm spending money to improve myself and get better. Don't classify it as online classes or seminars. Education. So my quick note here, is education deductible? Maybe, maybe not. If you're an employee and have no business, let's just say you're looking for some personal deductions, no, it's not deductible, unfortunately. But because there's no business purpose. But if you have a business, let's say you're a professional real estate investor and you want to stay up to date on things that are, the real estate markets, things of that nature. For us, we are all real estate professionals because you have a real estate license. So you get a continuing education deduction. A lot of your deduction can be, or excuse me, a lot of your education can be tax deductible. Just make sure you're labeling that as continuing education. So be thinking about that. A lot of us know, like, we can offset mortgage on our house, the interest on our house. We can offset interest on student loans, or deduct, we can deduct your cell phone bill, the mileage you're driving in your car if you bought a new computer, things like that, our board dues, stuff like that can be deductible. Think about other education you're doing, like if you spent the $58 on CE Cheap, right, to do your continuing education, that $58 could be tax deductible. So make sure you're documenting. What I will say too is small amounts add up to big amounts. So the better you get at documenting, the better you get at thinking before I spend money, is this a taxable event? Can I deduct it? If the answer is yes, I want to try to deduct as much as I can. So at the end of the year, I'm paying as little, legally, as little of taxes as I have to. Okay? So if I can get my taxes, what if I were able to pay 20% less in taxes just because I was paying a little bit more attention? Depending on what my income is, that could be $20, $50, $100, $200,000 more in my pocket that I didn't have to give away. So hopefully this was helpful. I know it's a lot. Again, as we move into this wealth series here in a couple of weeks, we're going to dive deeper into a lot of these things and really go deeper to explain it. But I feel like I like talking about this toward the end of the year because I think there's some things on here that people maybe aren't aware of. Or even if you've heard of them, you weren't super knowledgeable on what they were. But hopefully this helps to start thinking about adding some things into your business that you can start to get more deductions. And here's at the end of the day, everybody, it's all about making more money and paying less in taxes. So hopefully it was helpful. Appreciate you all being on. If you have questions, drop them in. I'll be hanging out here for a few more minutes. But I appreciate everybody being on, and we'll talk soon. Thanks so much.